The dollar was already sliding when Scott Bessant entered Bloomberg's studio. By the time he left, it had slipped another 0.5%. Traders weren't comforted, they were rattled. Despite Bessant's composed delivery, he quietly admitted something crucial. The August 12th tariff deadline was, in fact, negotiable. In diplomacy, that signals delay. In markets, it signals weakness. And in Beijing, it signaled opportunity. Bessant's core message? Don't panic. But the need to say it at all undermined the point. Real confidence doesn't require public reassurances. And if Washington really had the upper hand, it wouldn't be floating deadline extensions. The truth is, Bessant's hands are tied. Trump's tariff campaign has backfired. Instead of boosting output, manufacturers are trimming operations. The evidence is already in U.S. factory payrolls fell to 8,000 in May, a low not seen since 2017. Meanwhile, industrial production has shrunk for 4 straight quarters. The ISM index hit 45.8, well below the 50-point line that separates growth from contraction. None of this fits with Bessant's upbeat tone. The decoupling promise that reshoring would rebuild American supply chains hasn't delivered. It's raised prices and lowered production. Take aluminum. U.S. buyers are paying 42% more than global averages. Steel is up 33%. Copper? Almost 28%. These are essentials, not luxuries. Trump's argument that boosting domestic output is a national security issue doesn't hold up. Steel production hasn't surged. Plant capacity is stuck around 74%. He talks about making ships and missiles. But in reality, most aluminum goes into beer cans, not battleships. Bessant knows this. That's why he's rebranding the China deal as a win for consumers, not defense. But that pivot is fragile, because the deal's structure is already full of compromises. Bloomberg reports over 60% of U.S. imports from China are now electronics, semiconductors, and machinery parts, items that are critical, not optional. And yet, the U.S. has resumed export licenses for NVIDIA to sell AI chips to Chinese firms. Bessant confirmed this live, calling it a bargaining chip. But if the chip's already been played, what's left to trade? Meanwhile, inflation is creeping back. The latest CPI shows a 0.3% monthly rise in core goods, driven by rising input costs. For the first time since 2021, durable goods are outpacing services in price growth. Consumers are noticing. Markets are reacting. Treasury yields are rising, not because of strength, but because of risk. While Bessant promotes calm, Trump is reshaping the Fed's future. Jerome Powell must step down in May 2026 due to term limits. Trump has floated potential successors: Kevin Hassett, Bessant himself, and Thomas Waller. They all favor one thing: steep rate cuts. None share Powell's caution on inflation. That's a major concern. A high-interest dollar backed by strong exports attracts global capital. A low-interest dollar with slumping trade does not. And May's trade deficit tells the story. It widened to $97.8 billion, up 10% in a month. Exports dropped 6.1%. Imports barely moved. The imbalance isn't getting better, it's getting worse. Let's drop the illusion. This was never just about tariffs. It's about time, and Washington is running out of it. Trump's promise to revive U.S. manufacturing while isolating China is unraveling, not in theory but in real numbers. Vietnam, Malaysia, and Mexico have picked up some slack, but not nearly enough. American factories still depend on Chinese inputs, not finished goods, components. And these aren't interchangeable. A diode isn't a pair of sneakers. Despite tariffs, Chinese exports remain strong. In June, they rose 3.4% year over year, even with weakening Western demand. Why? Because, Beijing shifted focus to the global south. Exports to BRICS nations jumped 11%. To the Middle East, 14%. Tariffs haven't stopped trade, they've rerouted it. While Washington reacts with exclusion, Beijing responds with inclusion. Enter Australia. Prime Minister Anthony Albanese landed in Beijing not with ultimatums but with diplomacy. A trip to the Great Wall, a summit with Xi Jinping, a mutual agreement to revisit the Australia-China Free Trade Agreement. Behind the gestures, there's strategy. Australia isn't abandoning its values, it's hedging its economy. China is its top trading partner by far. In 2024, trade between them hit $220 billion, double the volume with the U.S. iron ore, LNG, gold, barley, wine. These are goods Beijing needs, and Canberra supplies. And Albanese knows time is short. China is developing its own mines in Africa. Its diversification drive is real. If Beijing becomes resource independent, Australia loses leverage and revenue. Mining accounts for 10% of Australia's GDP and supports 240,000 direct jobs, plus over 1 million more indirectly. Losing China as a buyer would devastate those numbers. That's the urgency behind the reset. Ironically, while Trump warns allies about Chinese influence, his policies are pushing them toward Beijing. Indonesia recently inked a $19.5 billion package with the U.S., including Boeing jets and LNG, just to reduce tariffs from 32% to 19%. Still not enough to compete on price. So what does Jakarta do? Buy more from China to stay competitive. The workaround is built into the tariff system itself. That's the contradiction. The U.S. created the rules of global trade and is now breaking them while watching others do the same. When America subsidizes agriculture, it's resilience. When China does it, it's manipulation. That double standard no longer flies. Nations are adapting, not to political doctrines but to economic necessity. And that necessity is dragging the dollar down. Bloomberg's dollar index has dropped 8.3% this year. Treasury auctions are underperforming. June's 10-year note saw the weakest foreign participation in 5 years. Saudi Arabia has cut U.S. bond holdings by 27%. Japan by 11%. China is now the second largest holder, not the first. This isn't a crash, it's a rotation. Investors are shifting from U.S. assets to gold, Chinese sovereign bonds, and BRICS-linked currencies. And with Trump favoring 1% interest rates under his chosen Fed chair, the dollar's real yield could soon dip below zero. That won't spark panic. It'll spark precision selling. Capital will leave slowly, but surely. Still, Bessant insists that markets are healthy. But currency traders don't buy reassurance. They buy spreads. And with Eurozone rates stabilizing and U.S. yields declining, there's little reason to hold dollars. Add in unpredictable tariffs and policy swings, and the greenback no longer feels secure. It feels unstable. Australia's shift illustrates the point. A U.S. ally, a security partner, a member of AUKUS, and now an economy leaning toward Beijing. Because in today's world, national interest is no longer about ideology. It's about economics. Albanese's trip included talks on green energy and agri-tech. The messaging was diplomatic. The move was strategic. While Washington offers submarines, Beijing offers markets. While Trump promises power, China offers stability. And while Bessant tells investors to stay calm, the numbers tell a very different story. Markets have already begun to price in the fracture. Commodities are no longer moving in sync. Treasuries are diverging. And currencies are, well, defying their old rules. Before 2025, global stocks typically fell when the dollar rose, a textbook safe haven pattern. But now, both drop in tandem. In March, United States equities fell 3.8%, and the dollar followed. That tells you one thing: the world no longer sees the United States as a refuge. It sees it as a risk. And here's the final contradiction. The country trying to isolate China has ended up isolating itself. Longtime allies are seeking alternatives. Former partners are pivoting. Economic leadership is no longer assumed, it must be earned. Tariffs were meant to correct imbalances, but in trying to tilt the board, Washington tilted the entire game. So, will Bessant secure a deal? Will China concede? Will the dollar recover? These questions won't be answered by slogans or headlines. Only systems answer systems, and right now only one side is building one. Germany's recent actions add another layer. Once one of the strongest United States allies, Berlin has launched an independent trade mission to Southeast Asia, skipping Washington entirely. According to the Financial Times, Chancellor Friedrich Merz told executives in June that supply chain sovereignty is now Germany's top priority. That language speaks not of alliances, but of autonomy. Despite falling demand in Europe, German exports to China rose 6.9% in the second quarter. Corporations like BASF and Siemens have expanded operations in Guangdong. Volkswagen has reinvested 2 billion euros into its EV joint venture in Anhui. These aren't temporary hedges. They're long-term alignments. And they run counter to Washington's push for de-risking. Because in business, risk leads to calculations, not campaigns. India, once viewed as the democratic counterbalance to China, is also shifting its posture. At the BRICS Plus summit in Johannesburg, Finance Minister Nirmala Sitharaman declared that India's trade decisions would be guided by strategic autonomy. Not alignment, not containment. Indian imports of Chinese and Russian goods surged over 20% year over year. Meanwhile, United States exports to India dropped 8.4%. Brazil's move followed. In May, President Lula met with Xi Jinping and finalized a plan to settle bilateral trade in yuan, bypassing the dollar. China now buys over 34% of Brazil's total exports, more than the United States and European Union combined. A BRICS currency fund is now in active discussion, and for many nations, holding dollars is starting to look more like exposure than safety. According to the United States Treasury's June tick report, net foreign purchases of long-term United States securities have declined 5 months in a row, the first time since 2008. The last time that happened, the dollar's global share fell by 4.6%. The IMF confirms the direction. In their latest coffer report, the dollar's share of official reserves dropped to 58.9%, its lowest in over 20 years. Meanwhile, the yuan rose to 3.1%, and central banks posted their biggest increase in gold reserves since 1967. These aren't symbolic shifts. They're strategic risk adjustments, and the contradictions keep piling up. The Trump administration accuses China of capital controls, while the United States restricts chip exports, energy trade, and outbound investment. It accuses Beijing of overcapacity, while subsidizing its own industry through the CHIPS Act and the Inflation Reduction Act. The line between protection and projection has blurred. For many outside observers, it has disappeared. Japan's behavior underscores this. In June, Tokyo signed a rare earth minerals deal with Vietnam, aimed not at cutting dependence on China but on the United States. Nikkei Asia reports that Japanese firms now view United States policy volatility as a long-term risk, even beyond Trump's term. That word, volatility, has replaced what was once called leadership, and volatility repels. It doesn't attract. Look at the Philippines. Despite strengthening military ties with the United States, Manila has also deepened its agricultural and tech trade with China. President Marcos Jr. summed it up simply, "We will not choose sides, we will choose interest." The phrase sounds neutral, but in a world of power plays, neutrality is no longer passive, it's strategic. So where does this leave Bessant? In theory, he's the stabilizing force, a technocrat holding the financial order together. In practice, he's the face of a strategy unraveling. He downplays the China deadline while headlines scream about it. He assures markets the dollar is stable, while capital slowly bleeds out. The recent 26% rally in the S&P 500 since April isn't driven by strong earnings. It's driven by bets on rate cuts. And if those rate cuts come from weakness, not strength, then the rally itself is a contradiction. The illusion of strength inflates assets, while monetary erosion speeds up underneath. It's a game of appearances. Until the appearances collapse. Beneath those appearances is the structure. Yes, the United States still controls SWIFT major clearinghouses and the world's reserve currency. But alternatives now exist. China's CIPS system processed $19.5 billion in June alone. India's UPI is now interoperable with Singapore, the UAE, and France. These aren't future possibilities. They're already in motion. So will nations use them? That depends. Not on ideology, but on dependability. And dependability is becoming synonymous with neutrality. If the US keeps weaponizing tariffs, rates, and restrictions, even allies won't rebel. They'll insulate. That's the quiet rebalancing, not a revolution, not rejection, a redistribution of trust. China brings scale. BRICS brings momentum. The US still brings infrastructure, but no longer certainty. And in a world shaped by inflation, climate pressure, and geopolitical flux, certainty is the rarest resource. Tariffs were meant to exert pressure. They've bred volatility. Trade policy was cast as a battle for sovereignty. Now it's a struggle for survival. Monetary dominance was once unquestioned. Now it has 20 contenders. So what happens next? Maybe Bessant flies back to Beijing. Maybe Trump reshapes the Fed. Maybe the dollar finds a temporary bottom. But the architecture has shifted. And architecture doesn't move with press briefings. It moves with structure. If this trend continues, where countries don't align with China but instead reorient around it, then this isn't a reversal. It's a reset. One where the US remains powerful, still relevant, but no longer default, no longer automatic, only influential by intent, and dominant only by design.